Hey, this is Sean Gilligan from Longs Peak. Gonna look today at a GIPS composite report to review the statistics that are required to be included, as well as the disclosures. Gonna share my screen here so you could take a look at what I'm looking at. And again, this is a GIPS composite report, and it's following the 2020 edition of the GIPS standards. So a little bit different than an older 2010 version. And also keep in mind now with 2020, we can have GIPS pooled fund reports or GIPS composite reports. This is the composite report. So it would be a little bit different if we were looking at a fund. So most of it's pretty standard and self-explanatory. We've got, if there were 10 years of GIPS compliant history, we'd go back 10 years. If not, we go back to inception of this composite strategy. We've got total firm assets as of the end of each year, composite assets as of the end of each year. If there were advisory only assets for the firm or for the composite, the firm would have the option to present that as well. That's not required, but it is something that there is guidance on now in 2020, and that could be included. Number of accounts, this is as of the end of the year as well. Gross returns for each annual period, net returns for the composite for each annual period. Similar for, in this case, this composite has two benchmarks, not required. You could have just one benchmark. This particular composite has two, so we have those for each annual period. Now, composite dispersion, just to explain a little more detail what that means, this is demonstrating how different the accounts are from each other within the composite for the entire year. So it's calculated based only on portfolios that were in the composite for the entire year, and it's the standard deviation of those annual returns. In this case, we'll see down in the disclosures that it's the asset-weighted standard deviation. You can do equal weighted or asset weighted, either is acceptable under GIPS, but we need to disclose that down in the disclosures to make sure it's clear which one is used. The reason why this is really important is because when we see these returns, we want to know, did almost every portfolio have a return of 32% for 2019, or were some up 40% and others up 20%, and was there a lot of dispersion? The lower this number, then the more tightly managed the accounts are to the strategy. If it's a high number, then you know that maybe there's a lot of customization or it's a broadly defined composite. So it's important to look at this number to know how meaningful these composite results are. And also, I think it's an important consideration to know, is it matching the story that the manager is telling? So for example, if this is described as something that's managed to a model, like if it's a wrap strategy or something that is really just implemented for liquid large cap equity, you would expect this to be fairly low. If this is a wealth management strategy with a lot of customization, or fixed income strategy where maybe holdings are different and there's different securities being used, then maybe it's going to be a little bit higher. Also with a balanced strategy, maybe there's a range of allocations included. If they're not all managed identically, then you're going to see higher dispersion here. Next, we have composite 3-year annualized standard deviation. So this is looking at the volatility of the performance over time. So it's looking at monthly returns over a 36-month period ending at the end of the year listed. And then we have the same for each benchmark. The purpose of this is to see, as an indication of risk, is the volatility, or in this case, standard deviation, is it higher or is it lower between the strategy and the benchmark? So ideally, you want to see a strategy that outperforms the benchmark and also has lower standard deviation, meaning lower risk. That would be the ideal situation. In some cases, it's known that the strategy is going to be taking more risk, and that's fine, but this is going to tell the story as to how much total risk was taken as demonstrated by standard deviation compared to that of the benchmark it's being compared against. Let's see, so down here we have a couple footnotes. First is relating to dispersion. So we could see that dispersion was not presented for a couple of years. In this case, 3 years. So the first 2 years, we can see there were fewer than 5 accounts, or 5 or fewer. So when there's 5 or fewer portfolios, you don't need to show the number of accounts, and you also do not need to show dispersion because it's just not going to be a meaningful statistic when there's really not enough inputs to do that standard deviation calculation. In this case, what's interesting to see is that there's 7 accounts and it still says that there's no standard deviation or it's not meaningful. Keep in mind that this is as of the end of the year. So they had 7 portfolios in the composite as of the end of the year, but that doesn't mean that there was more than 5 for the full year. We only are calculating this if there's more than 5 portfolios in the composite for the entire year. So here, let's see, next is another footnote, 3-year standard deviation not included. That's because there was not 36 months of data available yet for these first 2 years. So the first time we show it is year 3. Okay, so getting into the disclosures, pretty straightforward. We have the composite description. We state the benchmark it's compared against. If there's any minimum, that's stated. So here it's making it clear that no portfolios are included in this composite unless they're above $100,000. And now stating the composite inception date and creation date. So in this case, we could see that this composite was created in 19, but has an inception back to 12. So what does that mean? The creation date's important because it tells us that there was the benefit of hindsight when it was created. If there's a lot of changes to a firm's composite structure, it would become clear by the creation dates because all their creation dates would be more recent than the inception. Also, this could just mean that they became GIPS compliant more recently and just created all of their composites at this time. Next, we get into firm definition. It's important that the language here is consistent with the firm's GIPS policies and procedures. This is really important in how the firm holds themselves out to the public and determines things like their total assets that they report up here. The next 2 paragraphs are all the claim of compliance using the 2020 edition of the GIPS standards language. We can see that this firm is verified, but does not have a performance examination on this composite. We can tell based on this language here that clarifies that verification does not provide assurance on the accuracy of any specific performance report. If they had a performance examination on this composite, this would state that along with the dates of the performance exam. Next, we get into some details on what's included in the portfolio and the fact that there is a policy to temporarily remove any portfolios with cash flows above 10% of the portfolio size. So they have elected to have a optional policy, significant cash flow policy, to temporarily remove portfolios with cash flows above this predetermined threshold. Other simple standard disclosures, what is the currency used? Here, we're seeing that gross fees are reduced by trading costs only, which is what's required. Net of fee returns are reduced by a model fee. So here we need to make clear whether the net returns are based on model fees or are they based on actual fees. A lot of firms cannot calculate net returns based on actual because there may be portfolios that are paying by check or paying for the fees of one portfolio out of a different portfolio. And so the system may not have accurate net returns for every individual portfolio, which is why it's common to use a model fee. When using a model fee, it's important that the results are equal to or more conservative than what the results would have been using actual. So in this case, we're just clearly stating that the model was determined by using the highest tier of the fee schedule, which is the most common approach to use. Here, as I mentioned, when looking at the dispersion figure, here we're specifically mentioning that it is asset-weighted standard deviation. There are other ways to do that, like I said, either equal-weighted or, although standard deviation is the most common way to show dispersion, it's not the only way. You could show the highest and lowest accounts or different things like that. 3-year standard deviation is using gross returns. That's another thing that's required to be specified. Gross is common. You could use net if you prefer. And then just another standard disclosure that needs to be written exactly as this to make it clear what is available upon request. Finally, we have the fee schedule here. Simple language, typical to have a tiered schedule like this. Whatever the fee schedule is that you want to present to the prospect that you're showing the report to is what needs to go here. So this could change for each prospect you're meeting with. However, most firms choose to just have a standard fee schedule that they present and then negotiate from there. So this would be basically the highest fee schedule that would possibly be applicable, and is usually ties back to the firm's ADV Part 2, where then individual prospects can negotiate as the firm, if the firm is willing to do so. Last, we've got this GIPS trademark disclosure. This was new for the 2020 edition of GIPS. It's required to be included in all GIPS reports. At the very bottom here, we have the description of each benchmark that's used. Describing each benchmark is required. Sometimes firms will not, for benchmarks like this that are commonly recognized. Some will argue that the S&P 500, for example, is known, and just by indicating the name, that's enough. But really, the best bet is to just always include those descriptions if it's not clear that your prospects would always know what the benchmarks are. That's really everything for a standard GIPS report. Again, there could be customizations, other things that are necessary, like if you have non-fee paying accounts, if it's a wrap composite, if there's carve-outs. There are a lot of other situations where additional disclosures or different disclosures would be required, but these are the most common that we present for a typical strategy. If you have any questions, feel free to reach out. Thanks very much.